Welcome to Crushing It. I'm Jonathan Trimble. My co-founder Rob and I came from the FBI and the military, where the stakes were real and excuses didn't matter. We learned that persistence wins. You don't choose the situation, only your response. Those lessons shaped how we built Bond, helping businesses understand cyber risk and confront it with confidence. Business is its own battlefield. No fluff, no excuses, just leaders who step up. Let's dive in. So welcome to Crushing It. So, Rob, just to kick off, got a question. Do you think most founders raise money because they need capital or because they need confidence?
Well, I don't know any founders that don't need capital, short of the ones that are serial entrepreneurs. So that's a given, but certainly having an on-ramp, financial on-ramp would be helpful. Speaking of ourselves being first-time entrepreneurs, having a tranche of cash to be able to set up our administration and our background and everything would have been very helpful instead of month to month, just trying to figure out whether we can stay in business, 2 months down the road and looking for customers. So. I think lessons learned and I think Jeremy will definitely have a lot more insight on this, but I think the easy approach is try to acquire cash early but then you're working off of debt to start your enterprise. And I think that's a difficult position to be in for many companies that haven't established themselves yet. I think it's a twofold answer, John. And I think, it's, of course we all lack confidence, especially for first-time entrepreneurs, not knowing if it's going to pass or fail. But I'm happy with what we did. And I don't think it's a lack of confidence, and I wouldn't change it in hindsight.
Okay. Well, today's guest is Jeremy Middleton. He's an entrepreneur, investor, and CEO of Middleton Enterprises, and he may be able to shed some light onto that discussion point. Jeremy co-founded HomeServe with 10,000 pounds on a credit card, a business that went on to employ 10,000 people, became an FTSE 100 company, and was ultimately sold to private equity in 2023. But his path wasn't smooth. There's early failures and tough capital decisions, all that shaped how he thinks about risk, growth, and investment. Today, through his family office, Jeremy focuses on profitable SMEs, typically businesses making around 500 pounds in annual profit, and then helps them scale towards 5 million and beyond. He's known for patient capital and for warning founders about raising too early, raising too much, or giving away too much equity before the model is truly proven. In this conversation, we'll explore scaling discipline, founder psychology, misconceptions, persistence versus quitting, and what investment money actually solves and what it doesn't. So Jeremy, welcome to the show.
Yeah, nice to be here.
So you started with 10,000 pounds on your credit card and bailiffs knocking on the door. What did those early failures teach you about what shapes how you invest today?
I think it's taught me as an investor to have some sort of proven model before you start. There's what I say and there's what I do. What did we do? We had ideas, we started, and many things didn't work, and you pivoted and you changed and you ducked and dived until you could get something working. And you always thought things were going to work, but they just had a habit of not happening. So that's rather different from what I try to do as an investor, because as an investor, I have the luxury of choosing that I can invest later in that journey, and I choose to invest when the entrepreneur has got a proven model and is just reaching profitability. So they're quite different scenarios.
So you've been that founder under pressure from that early stage, and now you're an investor. So what do founders misunderstand about investors?
Well, I think that it depends what stage you are looking to raise money. I tend to think the best way to start a business is by bootstrapping it, by funding it yourself, if you possibly can, by using your own funds. That's where you try and prove out what's working and got the type of business where it can work. I wouldn't take investment if you don't need to. I'm an investor, but I'm saying don't do it unless you need to. Of course, that's not realistic. Often people need more money and more working capital. And then I think the best place to look is probably friends and family for equity investment. And the advantage of taking on equity investment as opposed to borrowing it is that you don't have the interest to pay and you haven't got the repayments to pay. The disadvantage is you've got to give away some part of your business. But if needs must, that's where I would look. Now, after that, people look for larger institutional funds. But when you go larger, that comes That's a whole different game. And it can be very difficult to raise those funds, whether from wherever you're trying to get them. Not impossible, and probably easier in the States than it is in parts of Europe for cultural reasons.
Yeah, you look at £500,000 as being the sweet spot for you. How did you wind up there?
Well, we're looking for somebody who has been in business. They know it's working. They've built a pretty nice business because it's worth £500,000. That's making $500,000 a year. And you'd think, well, happy days. Actually, they may be sitting on a business that seems quite valuable, but they haven't actually taken any money off yet. And that can be a very difficult stage. Are you going to carry on and create something big and exciting? Or are you going to try and sell out because you want to make some money? We like that stage where they're making $500,000 and we're saying, we want to help you scale up to go from $500,000 to $5 million. That's when dreams are made. That's when businesses turn from being worth a few £1,000,000 to being, or dollars, to being worth a lot. And that's a difficult stage to go through. But it's great from our point of view because we look for an entrepreneur who we can see knows what they're doing, who has done something, and we're suggesting you just need to do more of it and go on the journey, because it's the long-term compounding that makes the really big business. It's that persistence and sticking over the long haul is where the best returns come from.
So if you have someone who comes in at this stage, are there red flags that you look for or sometimes see that in spite of being at that level, there's some other things that you look for beyond just the bottom?
I think
the
there's a
annual
few
profit?
things. First of all, I think you want to find people who have a realistic plan, but we're interested in predictable businesses and paying a fair price. You want to see people who are looking to build a sustainable business over the long term, not people who come along with massive projections and reckon they're going to be the next Amazon, because that's great, but it's not something that is highly predictable. You also then find people who have really exaggerated ideas of the valuation. I mean, I think companies, and most people actually think businesses are worth a function of the cash that they generate now and in the future. Often entrepreneurs have in their mind a disconnect. They think it's a great idea. But and it may well be a great idea, but that doesn't necessarily add up to a sensible valuation. And the third thing I'd say is you want to have somebody who's interested in listening as well as talking. So you're trying to build a relationship. We look to be the junior partner with the entrepreneur on their journey, where you like each other, you're honest with each other, you respect each other, and you think that you believe in them and you're prepared to provide all the help you can and provide financial backing, but they have to be interested in what you're saying. Otherwise, there's really no point. And there are people who just want to be on broadcast. Well, I think you need to be on receive some of the time as well. And if they don't want that, that's fine, but we're not going to add value for them. And that's, they should go try and raise the money somewhere else.
I think that's a difficult idea. Very well put, though. In the young entrepreneur knows he's got to create his elevator pitch, and he's got the 30-second time frame, and he's got these flash meetings with investors. And so I turned myself from a person who wants to provide a professional service into I've got to market this thing and I've got to do it very quickly. And I think it's unfortunate because, like you said, oftentimes this is a conversation about, is there value, long-term value? And the 1 minute, 2 minute time frames for some of these meetings that you see in some of these entrepreneur conferences doesn't lend itself to any actual value. You don't get a chance to know the person or the company. It's just back and forth. And I think most of those folks, I've been in a couple of them, they're not even listening. They hear the numbers and then they're already moving on to decide whether or not this is an investment. And that's a terrible investment strategy, both from the people providing the potential capital and the ones that are seeking it.
Well, I think those conferences are generally organized by professional conference businesses who want
Very
to attract
much
a lot
so.
of people and sell them tickets.
That's true.
I don't think deals get done that way. I mean, when we want to be in an area, in a business or a sector, we will look at that business and that area and say, that's good tailwinds there. We'd like to invest there. Then we will go out and search for businesses who we'd like to invest in. They probably aren't looking to raise money, but we'll say, hey, we think your business is great. Would you like to have a chat? Most people with small businesses are interested in talking to people who've been there before and are interested in talking about the value of their company and not charging them any money. And when we find somebody, if there's a meeting of minds and we've talked about the long-term development options they've got, we may do a deal. And if we don't do one. But we've learned something. And by the way, when you've done that half a dozen times in a category, you actually get to know quite a bit about what those types of businesses are.
Right.
And so we're generally not approaching companies who've said, I've got to raise money. We're not working with companies who have employed a corporate finance house and who are then presenting all these wonderful numbers. And we're certainly not going to places where people are turning up for 2 minutes to pitch to us. Now, that doesn't mean people don't do it. And I'm not saying it can't work. But when of the people that I know who have raised investment, it's quite a long process and a considered process. So might take 6 months getting to know each other. I think the key thing is the facts. So people are investing on what is the reality of the size of this market, of your historic sales, how proven is your method of, how good is your product, how proven is your method of selling. And there's quite a detailed assessment. And then financial forecasts and an evaluation is reached and a deal may be done. The idea of going to a conference to hear people turning up who have an idea but aren't really in business or haven't really made much progress or have things with enough data sorted out or is going to do a deal in that sort of environment is, I think, pretty unusual. Hence, I say, I think this is, you see a lot of it. I know you do. We see it on the TV. You can see it on social media. You can see it at conferences. I'm not sure how real most of it is. I mean,
Yeah,
feel free to correct me. I don't
No,
claim to know
I
everything,
think
but I'm
we've
saying
we've developed
that's why
probably a
when
sense
I
of
say you want to
cynicism
raise
about
money,
that.
do it yourself, do it organically. Go to friends and family. And by friends and family, I include people who might have a strategic interest in you succeeding and know you and like you, suppliers, customers, people like that. That's the best source. Even going to find what we call business angels, people, private investors who you don't know, very, very difficult to do. Very difficult to do. In fact, I would look to switch towards targeting one or two smaller institutions, maybe family offices, where you can try and build a relationship and make a structured proposition based on the facts and the numbers. Something that shows that not only do you make money, but they make money.
Yeah, it's kind of interesting because you hear like two different dynamics out there as a founder. Like you hear that there's all this money available, like in the different tech scenes. Then, but I think that has changed a little bit where investors have gotten a little bit more skeptical or careful about how they invest their money. Whereas, if they're going to take it, they're not going to invest in just an idea or a concept, unless it's something that's absolutely revolutionary, and you can actually show that idea, if it's revolutionary, would actually have a chance of success. So,
I think there are investors who are, and certainly have been, much more focused in the sort of sectors you're describing of, let's call it tech, where money has been more freely available historically. Indeed, there were huge valuations on not much to get into many SaaS businesses until very recently. And that worked because the guys doing the fundraising could raise money because anything with SaaS might turn to gold. And then some people would go to those funds to try and access them, and they might duly get them at incredibly high prices. That bubble has burst pretty comprehensively. They can't raise money for the funds, and they can't raise money because they can't return the money they've already invested. And they can't return the money they've already invested because the prices they put on them are far too high. And of course, there's fantastic SaaS companies, but all those loss-making SaaS companies at crazy valuations are in a lot of trouble. And so that's why you even today find it quite hard for larger SaaS companies who are trading perfectly well to be able to float on the stock market and so on. Now, what has happened is the new SaaS. So now everybody tries to put the word AI into their pitch, and no doubt some of those factors are the same. But if, like me, you're operating in the world where you're not expecting to find the next Amazon or Google, great if you do, but I don't think I have the skills to do it, and I don't think there are too many of them around, then I'm saying I'm valuing you on the cash flow that you're producing, not on a massive multiple of sales. So, but these are the ordinary businesses. So I invest in, things like a quick service restaurants or low-cost gyms or skin clinics, bricks and mortar businesses on the high street. Now, for tech businesses are different. I do understand that. But there has been an awful lot of hype. And that's what you hear about. You don't hear about people investing as private equity, which is what we are, as a family office, into everyday, day-to-day businesses. But most businesses are day-to-day businesses. And there are some that are still succeeding very well. I made my business career on what was a plumbing business, HomeServe. effectively. And that's managed to go all over the world. So if you have a competitive edge in any category, the cards fall your way and you run it well, you can build a big, long-term, profitable, sustainable business.
I'd be very interested in hearing about I know, in today's world, you started that a while ago before the onslaught of AI, but an AI-proof business, I think plumbing is probably, the prime example of that, and electrician, great services to be in. HVAC, another one. How about soap?
Is that because originally I worked for
Yes.
Procter and Gamble, and I was selling soap for them in the UK. I mean, AI will affect all of us in all sorts of ways, including, no doubt, the sales process and the workflows for plumbers. And I'm sure Procter and Gamble will be using AI all over the place on their research and lots of other things. But that's different from saying that's a normal business tool. And I'm not, may have even more significance, but I'm not sure it has more significance, I don't know, than the internet. And, it used to be .com, and you got some of the same issues coming in. It wasn't enough to use the internet. It wasn't enough to put .com into your business. You needed to find the winning models, and people didn't know what the winning models were in the late 1990s. We know now because we know what's worked. And in the same way, it's probably pretty hard to think where the winning models will be in AI. But in all the businesses I'm involved in, most of them look at AI. Some of them are using it. Well, all of us are using it a little bit, and some of them are using it more. But it's not giving them, any of them, the competitive edge, because everybody will use it. It's like saying you use software. Yeah, sure. We don't do our books by pen and paper anymore. In our accounts. So I'm not sure that I've answered your question.
It certainly seems that, I would say 2 to 3 years ago, around the time we started, I know that the popular belief was that if you don't talk about AI in your business statement, then nobody's going to invest in you, because it's almost a requirement these days. So it's AI driven, this or that. And do you think that that's waned? I mean, I think that the popularity of AI is certainly being called into question these days, and the value to the expense ratio is certainly being called into question. Certainly not going anywhere. But do you think that the AI in business propositions or in seeking capital, you think it's overhyped?
Yes, I do. But it depends the nature of the business. I think it's a very reasonable question. What impact is AI having on your business? And it's a reasonable question. Are you using it? And if so, how? It's almost like a comfort to know that has been thought about. But if your business is not fundamentally driven by artificial intelligence, what's far more important is what's your business model? And I can't think that when I go to look at a gym that their use of AI makes a bean's bit of difference. What matters is, do you know how to build another gym? And is your gym better than the guy next door? Or if you've got if you're selling pizzas, then I would make the same points. Now, you might think I'm being really a bit, really down to earth here. It doesn't alter the fact that they may use AI in some ways, but I see most companies wanting to be aware of it, thinking how to embrace it. But it's way overhyped to think that you have to make AI the center of your proposition. It depends on the nature of your business, in my view.
I agree.
Yeah, no, and I think there's some disillusion that's come out with AI is, like if you're trying to do it's great for helping employees augment their ability to write an email or think about something through or just act as another reference. There's a report that came out a couple of years ago that for the banking industry that they should invest in every step of their loan process. And it seemed almost over the top where you're asking these very conservative organizations to go all in and completely revamp their processes, but without and I think this is one of the things is really defining what problem are you trying to solve. If you're implementing a new technology, whether it's AI or anything else, what problem are you actually solving? And I think your gym example is a perfect example. Is there a problem that you're really going to be solving through new technology? And probably not, in that case.
I mean, I have been involved with some of the companies who have call centers. And actually, they've been trying to improve the efficiency of call centers, well, forever, but over the last 30 years in various ways through various types of automation and embracing each new type. And each step is great and incremental. But AI isn't really generally producing some off-the-shelf solution which you can plug in and instantly shed half your workforce. It doesn't really work like that on the experience that, although over time it does improve efficiency. But also people talk about AI when actually, it's a chatbot. Well, people used to answer everything by telephone and by email, and then they introduced more automated answers. Then they also have messenger services, and then they have videos, and then they have computerized people answering, and they're all just a progression. So yeah, it's good and it's sensible, but it's not like the some revolution. And I've seen people in this context, so to illustrate, a call center, they say, great, we're going to use AI to improve our processes an awful lot. Great. Well, what you have to do is, first of all, make sure that the data that the AI is going to interrogate, like what all the possible answers are all in the same place. And then you've got to make sure that they can all talk to each other. And after you've spent a year with your lots of IT consultants getting all the data you had in a format that the AI can work with, the AI has then got to learn the right answers. And you better check them all before you use them for another year, because it needs a lot of information to learn from and it can make mistakes. Now, at the end of all of that process, and I'm exaggerating a little bit, you may well have a more efficient process than you started with, but it's not easy. It's not
How do
easy.
you extract that type of information from the perspective of an investor with a company that may make statements that, they're using it to enhance efficiencies or to reduce human, the human necessity for this area or reduce costs? How do you extract the real value behind that when you're an investor potentially having a conversation with somebody who's seeking money?
Well, it depends how important that improved process is going to be. Let's assume they've said they want us to invest because product X is fantastic. So first of all, let's focus on whether product X is fantastic. They're then going to say we're going to use a lot of AI to improve our processes. Okay, how much difference is that going to make? Are you going to improve it by 50%? And what does that mean in terms of numbers? Is critical to the success of the business. If we assume it is critical, I just like them to explain what they're going to do, because this is really it's software. So, well, what are you going to do? And they're going to give you an answer in plain English that you can, or American, that you can understand. In other words, we can reduce these heads over here because we're going to be doing much more with this sort of clever software. And over time, we think we can get to X. And if that sounds credible, I just ask sensible, ordinary questions. And if I don't understand them, then personally, I just wouldn't invest. I'm a bit like, well, I have to say a bit like Mr. Buffett, apart from all the billions he's got,
Right.
in the sense that he always said he would never invest in things he didn't understand. Of course, one's understanding develops. He invests in Google now, I think, but he didn't at the time.
I think you would.
But it's because he's focused on what's the core fundamentals of the business, what's the customer need, have they got a superior product, have they got great management, and this is just part of the process. Now, where it's wrong is if you're in the AI industry. Of course, if you're making microchips, then it doesn't even matter how, you can project forward the vast number of microchips that are going to be needed, because you can see how all those big companies are committing so much money to capital investment. So if you're in something like that, I can see that is the core business. But I wonder how many businesses really are.
So, Jeremy, are there problems that you can look at an investment that an investment would solve problems for, and are there things I guess more importantly, are there problems that no matter amount of investment is going to solve? Like,
Well, there are all the important problems probably aren't solved by investment necessarily. I think a business has to fix its problems. The problem it resolves is having the ability to scale faster. So if you need money to build a unit or you need money to buy stock, then that's the problem it solves. And if you want to go really fast or faster than you are currently growing, then you may need more and more money. That's what it's about. I would not, as an investor, be planning to put money in for them to solve a problem with the product, or to solve a problem, frankly, with the IT or with the marketing or with anything else. The money may be helpful for improvements, but you're not in the business of investing in businesses with problems. Why? You don't need to. I think an investor's job is to try and sift amongst the huge number of opportunities that exist down to the small number of businesses that are working and are likely to work. Now, I'm dealing in the particular sector of that, looking at particular types of businesses at a particularly early stage. And most of the institutional money likes to invest more money, put in large checks and do big deals with later stage organizations. But I'm talking about the early ones. The other stage at which there's institutional money is the one you referred to earlier, which is the startup phase, which is where they are looking to leverage the excitement of a category to encourage investors to give them money so that they can then bet on a whole bunch of loss-making businesses, and their economic model works, providing, that all of them are promising a golden dream, providing one or two of them delivers it. Happy days for them, but not necessarily for it's probably a very small minority of their portfolio that works. That can work for them. And that money all went into, I'm exaggerating, SaaS, and is now going into AI. And I think people investing in those AI funds need to be very careful.
Okay, reaching back to your early days. So how does a founder know when to persist versus quit? You transition from one type of particular product all the way over to plumbing. There must have been times along the way you're like, this is not working. Do I keep going or not? And I think a lot of founders go through that.
I mean, I had a nice job as a young person working for a big company, which is Procter & Gamble, which is where I jokingly refer to selling soap. But I felt that I wanted to try and run my own business at some stage. And I figured out I better do it sooner rather than later. So with a colleague, a friend, we set up a business that didn't cost us really any money at all to start with. We were able to buy some houses using almost 100% credit and rent them out. And we knew that worked. And then we started a property management company, which sounds very grand, but it means we'll manage your properties as well. And so people would pay us to do this. We were creating an income. We didn't need capital. And we started a number of related businesses like that. But none of it was really, we didn't need investment money. But on the other hand, we expected to make money to pay ourselves to live and to grow. We failed to do that because business is difficult and we were just doing what other people were doing. And so we opened a number of small businesses in related property areas. But in the end, we weren't making money. In fact, we were losing it. And we started to lose it when we said, we've got all these properties we're managing and they all have lots of problems. And rather than hiring contractors, we'll hire our own guys and send them out to fix them. And we created this business called A1 Fast Fix. It's going to go there within 24 hours, guys in yellow vans, call out within an hour, fix all these leaks. And we got lots of sales, but we lost money. Now, you say after that, you don't have a choice about persistence because we spent all our money. We couldn't get any more on the credit cards. Venture capital wouldn't back us. The banks wouldn't back us. We couldn't get any loans. In fact, we'd spent all the deposits of our tenants, not that we realized we had, which would be illegal now, but wasn't then, as long as you paid it back. And we were in a lot of trouble. We actually had no choice but to keep going. And in the end, we found a joint venture partner. What does that mean? I went to a small water company and said, you're looking at diversifying, and I know you're looking at going into plumbing. We'll do a review for you. And our review said, you're going to set up a small, directly employed regional plumbing business. And that's a terrible idea. But there's a really good idea, which is you should focus on emergencies and you should go do it nationally and you should franchise it out. And it's going to be a big business for you. And they said, yeah, okay, we're pretty interested in doing that. We said, there's one problem. You really need some entrepreneurs to run it. Well, actually, we know a business like that with entrepreneurs. And the really good news is it's free. What we did was we said, we'll give you our business and we will run it here. And you just provide some working capital. And we gave them 52% in the end of that business, ostensibly for nothing. Actually, it meant that we stopped losing money because it became part of it. And we got a balance sheet from them to invest in marketing. And over time, a version of that business grew into a very, very big business. In fact, it got to be bigger than the water company, which we sold off at one stage. So what does that say? We nearly went down. We persisted. Was that a concrete decision? Didn't have any choice, truthfully. And then we either did a brilliant deal or we got lucky. What learning can there be from that? I do think persistence pays. I do think once you've started, you've got to commit. I do think you've got to be prepared to pivot and look for things until your model is proven. When you get that, and by that I mean, gosh, I can see how we generate cash, then press a button and do the same thing and don't change it. And that's your golden ticket.
So in that same model, had you had the the Jeremy Middleton knowledge and wisdom that you've acquired over the years now, are there mistakes that you saw that you made that could have ended up a different path, not in that point where you had used up all your capital? Were there business decisions or modeling decisions that you could have made that would have changed that outcome where you weren't so desperate?
Yes, I think we were so keen to start that we just started things when more thinking and consideration for how you can be better would have made sense.
Boy, that sounds
We
familiar.
Uh, I'm not saying I wouldn't make the same mistakes again. I just would like to not make the same mistakes again. And then we thought very poor financial understanding and control, but you don't know what you don't know. I mean, there's all sorts of elements to that. Doesn't mean we didn't know the basics of finance. We know what a profit and loss is, but we weren't keeping a track in a proper way of our cash. But in the end, the conclusion you draw is stay small and till you've got something that works. Then raise money to make that a big business, but raise as little as possible and maybe raise frequently. Because if you wait to the stage that we did, which is where we had to do a deal, then you give away an awful lot. And so I think that's the most important conclusion, which is very high level. And everyone will think, well, of course, I need to know what my proven business model is. But there's a big difference between an idea and a plan on paper and starting trading and knowing, because you can see the results, that this business can work. But you're kidding yourself. If you expand a failing model or a model that doesn't really work, you're just creating bigger problems. Now, actually, we grew that plumbing business for a couple of years and we told them it was going to make them good money. And we grew a small loss-making emergency plumbing business into a big loss-making plumbing business. And many partners, as the water company was, would have closed it down. Actually, they stuck with us for quite a long time. And in the end, it only worked because we turned the whole business model around, which was from, instead of paying money to do marketing, to find plumbing jobs, to quote for them, to go and do them, to then try and collect the money from the minority of people who have an emergency plumbing business. We started to sell the same service, but as a warranty. So we'd sell it to anybody. Here's peace of mind. If you have a plumbing leak, we will come out and fix it. You just pay for your annual policy up front. And suddenly, people who signed up would send us money and we would then provide them the cover. And the whole cash flow was turned on its head. So it's an entirely, in one sense, it's the same thing. It's plumbers going out, fixing problems. In another sense, you've turned the economic model on its head because you're selling peace of mind and collecting cash before an event. And indeed, many people will buy a policy and get that peace of mind that they've got plumbing cover, and then they don't have a plumbing leak. And that makes a huge difference. So it's only when that was there, we then did a lot of marketing to try and get a lot of customers.
Yeah, Jeremy, you talked about the decision to give up such a large portion of equity because you're in a position of desperation. You kind of warn against doing emotional decisions. But do you think that decision actually helped you in the long run? Your partner, like if they had a lower amount of equity or stake in the company, would they have been less likely to stick with you for so long?
Yeah, they wouldn't have done a deal unless they had 52%, the majority from day one. And indeed, they had the right to buy very cheaply from us up to 74%, because they're a big public company. At least that's the way it seemed. So if we hadn't done a deal with somebody, we would have gone bust. So that makes it an easy decision.
Yeah.
Actually, it was the best deal we've ever done in my life, giving away 52% of something, because we gained the cash flow needed and the time to learn how to pivot, but we also got other things from them. They had a brand name. They had customers. They do know about customer service because they run call centers, and they were better at us than us on many of those things. So I'm always urging people to be very creative about where you look for investment. And if you add an investor, 1 + 1, can you find a way to make it make 3? Because what else do they bring to the party? And I wouldn't be afraid of giving away something, because you're giving away something that's not that valuable. It may become so if what you do is you increase the likelihood of that business succeeding. It's a bit of a counterintuitive way of thinking about it, but it can open up all sorts of deals with and sometimes with people you might not think would do a deal, like in this case, a listed water company with a little couple of guys with a few vans running a loss-making plumbing business in part of England. And I think there are opportunities like that.
Yeah, I guess partners, you never know where they're going to come from and how the relationship's going to grow over time. So after you've, built and exited such a large company, what drives you now?
I tried all sorts of different things in investing terms because you do. I only do one thing now, which is invest in small businesses. And that's because that's what I understand and enjoy doing. So our business says its objective is to help entrepreneurs achieve their dreams. It's that helping people move from that stage where they've just made a bit of profit towards making a lot. And that's what makes a huge difference to the founder. It makes a huge difference to their employees. For what it's worth, they end up paying a lot of tax pay for everything else in society. And of course, if we can succeed, then we'll benefit as well. So it's working. We try to work with only us and the founder. So we're not investing alongside other financial institutions. I mean, there may be friends and family in there because we're trying to form that junior partnership so that we can do our best to add value to them. And typically that would be helping small businesses make the decisions on whether to raise more money, whether to borrow money, whether in fact it makes sense to keep going longer rather than exit. We sometimes will buy some founders' shares so that they take some money off so that the business will go longer. We might be bringing more analysis to decisions of where they have sites or what they do in their marketing. It's a variety of things like that. We don't particularly promise things, but we do our best because we are their junior partner. So we have completely aligned objectives. And as using our own money, not a fund, we haven't got to return it. I mean, we do want it back one day. We are trying to make money, but we don't have to return it to our investors, which can create a conflict if your shareholder, who you're in partnership with, wants to sell. Because I go back to the Mr. Buffett and his view on compounding. It's holding a successful, growing compounding business for a long time that is most likely to make the founder of an SME into somebody running a bigger, impactful business.
I imagine you'd have to structure your deals a little bit differently than your typical investor. If your target group is small to medium enterprise, your patience level for return on that investment has to be a much longer trajectory, assuming that it's going to take 5 to 10 years for that organization to grow to a point where it's viable to exit. Are you looking for something in the interim from a return? Are you looking for a capital return on an annual basis, or are you traditionally still just waiting for the potential for that organization to exit?
Well, perhaps we're a bit unsophisticated, but we just take straight equity on the same basis as the entrepreneur. And we say, we make money when you make money. And that creates aligned interests. Now, we don't push for exits, but you will naturally find, if you've got a portfolio like we do, that at some stage, most founders do want to look for some type of exit. And of course, we'll need it occasionally to exit or we can't do anything new. But no, we're not looking for any preference shares. So we don't have any greater rights. We're not looking for interim dividends. I mean, if the business is spinning out cash and we don't want to sell, that's great. They can take dividend and we'll take dividend, but we'll take it on the same basis.
I see.
So we're trying to get aligned interests and keep it simple. We sort of say we're offering founder-friendly finance, or as founder-friendly as we can be.
Well, Jeremy, I really do appreciate you taking the time to join us for our podcast today, today's episode. One thing really kind of struck me that when I reached out to you, that you personally replied. I imagine there's a lot of people that are, vying for your attention for different things, but you seem to have very much a personal approach to things. The other thing kind of stood out was that you seem like you're a true family office. I see a lot of people in your office that have the same last name as you do.
Yeah, well, it's right. I mean, it's easy to find me because we're a small office, because what we do requires a small number of correct decisions rather than a vast number of smaller ones. And yeah, I work closely with my son and indeed my daughter. There are 9 of us in the business, and I find that really rewarding. I mean, I'm trying to build a business and a brand here. You could say, well, why? You could go and lie on a beach somewhere. Well, not very good at lying on a beach. And we all need purpose and stimulus. And from a commercial point of view, I'm building a brand I hope my family will carry on running. Won't matter. They can do what they want with it when I'm gone, but I'm not planning on leaving anytime soon.
God willing.
Well, that's terrific. I mean, if you can kind of build a business that supports, beyond when we're around, that's a true success story just beyond just that moment of building and exiting a company.
Well, I hope so. That's what we're trying to do.
Well, thank you, Jeremy. Really appreciate you joining us, and
Sure.
really great conversation. Thank you so much.
Thank you. Hope it works for you. Thanks a
Okay.
lot.
Thank you, sir. Take care.
Bye.